I'm Russ Mould, AJ Bell's Investment Director, and welcome to Fundamentals, a series of videos looking at the world of funds and collectives. In each edition, we will highlight one of the most popular purchases on the AJ Bell Youinvest platform, and then analyse why your fellow investors might be buying right now. This week, second on the list for passively run funds is UBS MSCI Emerging Markets. This is a tracker product or exchange-traded fund, ETF. It's designed to track, mirror, the performance of the underlying assets and deliver that performance minus any running costs. This means this particular tracker is following a broad index of companies based in emerging markets quoted across a range of stock exchanges. Here, UBS MSCI Emerging Markets uses physical or direct replication to generate performance, so it owns the underlying securities. In this case, the 5 biggest holdings are Korean technology giant Samsung, Taiwanese silicon chip player TSMC, Chinese investment company Tencent, telecoms player China Mobile, and South African tech and media firm Naspers. The chart here shows the tracker's weightings by region, with Asia dominant, and this one shows the weightings by sector, where financial services, tech, and consumer cyclicals are particularly prominent. The tracker comes with an ongoing charge figure of just 0.45%. This is admittedly higher than many trackers, where the charges can go as low as 0.05, but this is a result of where the tracker operates. Emerging markets can be less liquid than their developed counterparts, so the costs associated with physically following the underlying securities will tend to be higher. Do note, however, that the UBS tracker is still pretty price competitive. According to Morningstar, the average ongoing charge figure for the 48 global emerging equity market ETFs is around 0.45, 0.46%. The UBS product is around £330 million in assets under management, so it should be pretty liquid under normal market conditions at least. It's SIP and ISA eligible, and this particular instrument comes with income or distributing units, so any investor buying it will receive dividends in cash rather than see them rolled up and reinvested. The tracker is nearly 6 years old and comes with a 3-star ranking from Morningstar for those who place importance by such things. The tracker comes with dollar or sterling priced options too, and this chart here shows the performance of the sterling version since launch. And as a final point, UBS MSCI Emerging Markets is one of the 16 members of the top tracker list used by our investment guidance service. It represents 7% of the balanced portfolio and 15% of the adventurous one. Okay, so those are the mechanics out of the way. The question now is, why would investors be potentially buying now? And I think there are 3 possible reasons. First, commodity prices have been trying to forge a bottom. Gold, iron ore, oil are all up so far this year, and even copper's rallied, even if it's given up a little bit of that ground recently. Now, not all emerging markets are net commodity exporters, but some big ones are, Brazil and Russia, for example. And it does look as if the MSCI Emerging Markets Index and the Bloomberg Commodities Index have had a pretty close historic relationship at least. Second, the dollar is going down as markets ponder just how many interest rate increases the US Federal Reserve will push through this year, if any. The US Central Bank had initially targeted 4 1/4 point hikes to take the headline Fed's funds rate to 1.5%, but the market now suspects we may get 2 increases at the most. This is pressuring the dollar, and as we can see here, there's a strong historic inverse correlation between the buck and emerging market equities, so a weak greenback may help this UBS tracker perform. Finally, emerging markets, well, they've just been horrid for the last 3 years, as share, bond and currencies have all been hammered. This suggests there may be some value to be had, especially as research from fund management giant M&G suggests emerging market stocks trade on a price to book value ratio of 1.4 times, towards the bottom end of a 20-year range and well below the peak of 3 seen in 2007. Now, there are no guarantees here. That ratio troughed at 1 in 2008, and emerging markets underperformed developed ones for 8 straight years, not 3, following the 1997 economic crisis. But for the moment at least, buyers of emerging market assets are enjoying themselves. Emerging market stocks romped higher by 13% in March, their best month since spring '09. But any investors buying this tracker will need to keep an eye on the dollar and US interest rates in the short term, as well as the economic prospects of emerging markets in the long, if they intend to keep this one in their portfolio. The next 2 Federal Reserve meetings are 26 to 27 April and 14 to 15 June. So thank you for watching, and I look forward to seeing you next time.